It's October 29th. It is a Thursday. Of course, this is the video log. It takes 30,000 to a million. Hasn't happened yet. I'm not moving in the right direction at the moment, but I think things will turn around pretty soon. I'm going to do a brief overview of the account, and then I'm going to talk about not failing companies, but money-losing companies, companies that burn through cash, and value-destroying companies. So it's a concept that all investors should be aware of. And in case you're not aware that companies can destroy a lot of capital, literally, not like banging it with a hammer, take some capital and then crush it down and throw it in the garbage, but might as well. Okay, so it's definitely value destruction. And it's sort of more like a warning or something just to be aware of whenever you're investing. So first, I got to take you through the account. It's had a pretty big dip, mainly because of Apple's, aftermarket results. The option is gonna open up even lower the account tomorrow, on Friday in the morning, because the options haven't registered yet. So that's gonna be another minus $2,000 or something like that. But anyway, here's the account. I'm sitting currently at a little bit over $13,000. I was as high as 116,500. Now I'm 113,600. Most of the options were positive here. You can see that I'm erasing some liability from all these put options. As always, you can pause the video at any moment and take a look at the symbol, then the strike price of the option, whether it's a put or a call, the expiration date, number of contracts, and whether it's a sell or a buy. And you can see that virtually all of these are sells except these last three, which are three Apple calls. And they went okay today, but after market, of course, after the big drop of Apple, they're not gonna do okay in the morning. So here are the rest of the positions. Most of them are positive today, including some of the real estate, oil, and financials, including actually, resources like energy, uranium, gold miners and silver miners were a little bit up today. All that stuff was pretty positive, despite tech being sold off quite a bit. So very interesting. So that's the account. If you're interested in the account tab, here it is. This is sorted by total return, Apple, Wheaton Precious Metals, Visa, Newmont. This is excluding options. And then total equity, Apple, Power Shares, Emerging Market, PCY. These are bonds, emerging market bonds, realty income, Wisdom Tree, EDEM, so that's emerging market dividend stocks, then Cameco, etc. So I got a lot of losing energy stocks at the moment. You can see Energy Transfer is the biggest loser at the moment, down $1,500. Schlumberger, whatever you want to call it, down over 1,000. New York Mortgage Trust 900. Energy Fuels 700. Shell minus 600. So these are most of the losers here. And here's the graphs. This is the daily, weekly, pretty bad, minus 4%, monthly minus 2.5%. In 3 months, I'm actually still sitting at a gain at almost 12%. And this is the yearly chart, plus 28%, which I guess is okay still. But definitely the indexes are catching up on me, and I think it's partly because I've been reluctant to take profits from Apple, and also because I've been so heavily trying to get into energy and real estate and all that stuff. So I'm missing out probably on some opportunities, but I tend to go in very early into trades, and so I will be paying the price for that. Currently, I am using leverage if you're interested. So you can see right here how much margin I'm using, and about $11,000 at the moment, which is about 9% of my total market value of 124,600. So this just means that if things go sour and the markets start dropping, then I'm going to be paying the price more so. I'm going to be definitely losing quite a bit. But I'm not really looking for a big correction or a crash around the elections and even after that. I think either tech is going to stay pretty steady and maybe the rest of the market's going to start catching up, or everything's going to go up. I'm really not looking for a big crash, but if it does happen, I'll probably lever up some more, so we'll see what happens. I'm not scared of losing it, the entire account. But people should be scared, okay, which is what I want to talk about today, is people should be scared of money losing companies, okay? So you can have companies that really burn through a lot of value, a lot of capital. Some examples could be shipping companies like dry bulk. You could have mining companies are really notorious for that as well. Okay, a lot of the resource-oriented companies, some energy companies. So there are many ways that this could happen, right? So normally when you have a company, maybe in the S&P 500, especially because they have to be profitable, right? You have a company that makes money over a long period of time and is consistently profitable. Maybe it grows, maybe it stagnates, but it turns over money, right? It's like having a restaurant and you end up with a profit at the end of the day. But some of these more capital intensive companies where you need to invest in equipment, lease land, hire tons of employees in order to get some kind of resource out of the ground, then it's actually very likely to lose a ton of the capital that's initially invested in you. You being let's say the CEO of this company, or who the controllers, I don't know, the board. What could happen is, for example, you could overinvest in infrastructure. So let's say a mining company, for example, you could have, you could hire more employees than you need, and for not enough return in the ground, you could misjudge the amount of resource in the ground. You could spend too much on machinery. You can sign a bad contract for delivery, right? You could underprice. And that's the other thing for a lot of these commodity-based companies, is that the silver or the iron or the whatever nickel that comes out of the ground, it doesn't have your brand on it, right? It's not a branding story. Like, it doesn't matter where this nickel comes from. Nickel is nickel, right? Well, nickel actually is a little more specific. I picked a bad example, but let's say gold is gold. Okay, it doesn't matter which company it comes from, which symbol it carries. It can also always be melted down and rebranded, and you'll never be able to tell the difference, right? It's not like Louis Vuitton or Tom Ford or Gucci or something where branding really matters. And what happens as a result of that is that the price of the thing that you're selling is really not controlled by you. It's controlled by more market forces, supply and demand, and you are kind of slave to that. And it's very, very common that a certain project or an entire company will just not be viable if the price of a commodity changes. All right. So let's say I'm mining iron, and it drops down, and I do my calculations, and I figure out that at a certain price I'll be able to make a profit. But if I now have to sell half of that price, then I'm not profitable anymore. And so I end up just burning through cash. And the big thing about that is that these expenses, this kind of burn through cash, will never get it back as investors, as shareholders, as owners of company. We'll never get it back. And if you have to burn through cash and sell at a loss for 2, 3, 4 years, that's a lot of capital destruction right there. So you're going to count on investors to keep feeding you and funneling you money in order for you to keep your operation, in the hopes that at some point the price of the thing you're selling is going to go up. And it's very risky. I mean, it's likely that this company will go bankrupt or so deep into debt, its stock price will go to zero. And sometimes what these companies are forced to do is, it's not always forced, but sometimes they are forced to issue more outstanding shares into the market because they'll need cash to pay their employees, right? To pay the lease on the land, to keep their claims, or whatever they need to pay in order to some kind of licensing or whatever, machine maintenance, the salaries of the CEOs, right, of all the managers or whatever it is. So these people need to get paid, and so they'll issue shares into the open market, sell the money, basically sell more shares into the market, collect the money, and now the current shareholders and investors have a diluted share of the company. Now, the valuation of the company doesn't really change at that point. I mean, yes, you own a smaller part of a company, but you own a smaller part of a company that's less bankrupt. Okay, so because they've raised the cash, right? So all these, whenever stocks, they do stock buyback and or stock issuance, it doesn't really change the picture. Okay, because if they do, let's say they do a stock buyback, which means that the company goes out into the open market and purchases some of its own shares. What that happens is the effect usually is that the stock price will go up because there are just less shares and more people going after it, including the company itself. So supply and demand, right? But yes, you might own, you know, you might be one of the fewer owners of this company, so you own a larger share of the company, but this company that just you own a larger share of has spent money that it had to buy up a bunch of shares out of the market, so they no longer have that cash. So even though you're a larger owner, you're a larger owner of a smaller company, right? One that has less cash. Whereas in the reverse, you're a smaller owner, but you're a smaller owner of a larger company, or one that has a bit more cash, or at least enough to pay its bills or whatever. But that's a little bit off topic, right? My point is that you could be investing in a company that just has no way out, and it keeps burning through cash. And the thing is, this cash will never, in some cases, will never come back. I mean, maybe I can pull up a couple examples that I was looking at earlier. Like, you see this company here? I mean, Globus Maritime, it's a shipping company. But I could pick any resource company really, but shippers are kind of comical. There used to be this company called Dries Bulk, whatever. And it's just notorious. I mean, it used to be like $6 billion per share, and then it's like 5. It went all the way to 5. So they will never reach these heights. So I'm willing to bet that, this company that used to be $97, it dropped all the way down to like 12 cents, and now it's maybe 7 on this spike, 7.8 or 2.8. I'm willing to bet it's never going to reclaim that $97 because this company has done so much destruction value that it will never make it up. I don't really have any other examples on the top of my head, but I might bite myself in the ass for picking this one. But there's definitely look at energy fuels. It used to be super 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 high during the uranium boom, but even if uranium went up to that price again, energy fuels is not going to be, it's going to spike up quite a bit, but it's not going to be at that price. It's not going to be worth 3 trillion, 3 billion or whatever, 2 billion per share. I don't know what it was, 2 million. It's never going to get up to that height. Don't quote me on these numbers, by the way. Look them up on your own. Go on like Google something that gives you more than 5 years. Unfortunately, Robinhood doesn't. But it's that price is not going to be reclaimed, right? Maybe energy fuels could go up to like $100, $200, $300, but it's not going to be 2 million. And it's when you're dealing with, there's a lot of upside volatility on these kinds of stocks, and you can make huge gains, right, with these commodity companies. But you just have to be aware that they're not long-term holds, and in many cases, some of these companies really need to kind of eat through, all right, their capital, and so it leaves the shareholders with nothing at the end. in order for the company to stay alive. And so you basically, if you keep buying their shares, you're basically feeding this beast, insatiable beast that it never actually produces anything for you until the price is right, and the price may never be right. Or the company could just go bankrupt before the price is right, you know. But that's kind of what I wanted to warn y'all about, and that's what it's been on my mind lately. So, with great risk comes great reward, but you shouldn't forget about the risk aspect of that sentence. Apple's not gonna go, up 500% in a year from here on, right? But a mining company might, and for that kind of reward, the prices, the fact that it's a very capital intensive, capital burning type of company, they'll have to do that jump, and hence the valuations. I mean, have you seen some of the oil valuation of these companies? These companies are just nuts, right? But anyway, so be aware of the sectors that you're investing in. I certainly am trying to be more conscious about it. I slowly started exiting a lot of my mining positions this summer, and one of my other accounts, and I'm trying to lighten up a little bit on the silver and gold miners, but I still have quite a bit. But I'm turning some into cash, and I'm trying to put some money into oil and real estate and things like that now. So those are the moves that I'm making, and that's what has been in my mind. I didn't make a video on Monday. I'll probably make one this Monday, though. It's just been a lot going on, so. But hopefully you found this interesting, and if you are actually making money through this period, let me know. I want to know about it, so write me. All right, I think that's it for now. Peace out.